Okay, well, so we're just about there. So I want to welcome everybody to the Tuesday morning webinar. And I want to just go over some housekeeping. So for those of you listening, just listening to this, I'm going to do my best to describe what's going on. I do share the Ed Slott report that I read to you, and the mailbag. And the mailbag is questions that come in from people around the country, and it could be retirees and consumers like yourself. It could be financial advisors, CPAs, and other professionals who write in with questions. And there's also typically at least one article written by one of the analysts on the Slott team that I share with you, because this information is always good to keep top of mind. It helps you avoid making mistakes in your own distributions. That's really the goal, and it's when to know to ask for help sometimes. So I'm going to read these things out loud to you, but if you're hearing it and you and it's something you want to go back to, you can always go back to the YouTube channel. The topics are indexed, so you can go to what area interests you the most. So we're going to go over the Slott updates. That takes about 15 minutes, and then we're going to go over market updates. So we're going to talk about what happened in the markets last week. I'll share some analyst reports and my thoughts about the coming week, and just going forward. And then we're going to go over our financial planning topic. And our topic today is 5 common retirement mistakes. So we're going to go through, and hopefully that's about 15 minutes, maybe 20, 25 minutes. But we're calling that our financial 15. So I'm just going to remind you about that when it comes, because some people just join us for that section. So we have the entire webinar and the financial 15. And at some point, these webinars are going to become private. So you'll have to be a client or a member to access the entire webinar via live or via recording. But we're pretty close there. The new website is probably about, I'd say, 3 weeks, maybe 4 weeks away from launching. The Attleboro U website, which is going to be our education-based website, is going to be a few months behind that, because we're pulling all the content together. But when we have the Attleboro U website, that's when we're going to have that membership portal, and that only folks, again, who are members or clients are going to have access to these weekly webinars and the recordings and everything else other than the financial planning topic. I think we'll include the financial planning topic as a general YouTube video, but maybe we'll include that with a membership as well. I'm not sure yet. But if you're just joining us, so welcome to the webinar. We do have some classes going on right now at Holy Family University here in Newtown, and that is on Campus Drive in Newtown. We've got a series that starts tonight. So it starts at 6:30 tonight. So if you want to attend that series, you can join us. Starts at 6:30 this evening, goes to 9:30. I know it's a long night, but not as long as it was Saturday. Saturday, we had a great group of individuals at Holy Family, and that class went from 9 to 2. And that's a lot of talking on a Saturday morning after St. Patrick's Day. And I didn't go out on St. Patrick's Day, so I felt fine, but it's still a lot of talking. It was a fun class. I always enjoy the Changing World of Retirement class, and I hope everybody got a benefit from it. But we've got a class starting this evening, as I said. It'll be tonight. And next Tuesday, we have another class that continues on Thursday, the 23rd, and that'll be the second in the series. These classes are in 2-class series, typically 3 hours on a Tuesday, 3 hours on the following Tuesday, or 3 hours on Thursday, 3 hours on the following Thursday. And you can mix it up a little bit. So if you wanted to really cram it in 1 week and not attend the whole 5 hours, obviously the 5-hour class on Saturday is what's not included is estate planning in that. You could attend tonight, Tuesday night, and Thursday night. Get it all done in 1 week if you were so inclined. So the next big event is we have Ed Slott and David McKnight joining us on May 16th, as you may have heard me mention earlier before we went live here. May 16th, Dave McKnight and Ed Slott are coming to the Newtown Theater in Newtown, Pennsylvania. That is a Tuesday evening, starting at 6:30. We're going to go to about 8:30. And we have the 2 big hitters in the country, big thought leaders on effective retirement planning and distribution, certainly tax-efficient retirement planning and distribution in the nation, joining us here on May 16th. So mark your calendars. Yes, you're going to get an invitation. for sure. And I hope you can join us. So today, as I mentioned, so we're gonna have the slot updates. We're gonna do the market updates, and then we're gonna spend the last 15 minutes or so talking about the five most common retirement mistakes. Well, I don't even know if they're the most common, but they're common retirement mistakes that I see. So we're going to stay with 5 common retirement mistakes. So before we get into that, let's talk a little bit about our headlines. So more bank discussions, right? UBS shotgun wedding to Credit Suisse over the weekend. So this is kind of what happened in 2008, 2009 with this forced mergers of it happened with Smith Barney to Morgan Stanley. It happened with Merrill Lynch to Bank of America. And the story goes that Bank of America didn't want to take over Merrill Lynch, but the FDIC and the head of the Treasury said, if you don't do this, don't ever come to us for anything ever again. So they were that was a shotgun wedding there. And we're seeing this again. So should you have concerns over what's going on in the banking industry? Sure, you should have concerns. So there's large, the Credit Suisse it's been a storied kind of troubled organization, but this is when these cracks in organizations become huge fissures that things can fall into. So I worry about some banks that, have had some regulatory issues, that have been fined billions of dollars, that I wouldn't recommend anybody do business with, even though they're big names. But I worry about banks like that, and I worry about smaller banks for sure. So this is a time to make sure that you're in tune with the amount that you have on deposit, what your coverage amounts are, really what you're getting for that relationship, and what your protections are. So the small organizations don't like to talk about FDIC thresholds, and they don't want to see deposits pulled out, nor do the large organizations. But that doesn't matter. You have to take care of yourself. And there's really, really easy options. You can right now, this is not a recommendation. It's different for everybody, but right now you can hold short-term treasuries and you're getting close to 4 point or over 4% for 90-day U.S. government bonds. That what that means is that they mature in 90 days. So there's no real reason to keep anything in a bank that you're going to need longer than, or during that 3-month period. Because there's nothing safer, believe it or not, than the bonds issued by the U.S. Treasury. So, but the U.S. government has said that they're gonna come up with some kind of strategy to backstop these banks. They just don't know what it is yet, because if the president comes out and says, "Don't worry about it, your deposits are safe," it doesn't mean anything, frankly, because he can't write law, any president. I'm not just talking about Joe Biden. I'm talking about any president. So there has to be cooperation in Washington, and they've got to fix these regulations. And sure, you should be able to have $1 million in deposit or some higher level covered. So it's important that this gets worked on. All right. So moving into our slot updates, they're kind of the headlines today. The other headline, of course, is the Fed. What will they do tomorrow? When they have their Fed meeting, and there's a lot of speculation. We hope that the bank situation isn't going to scare the Fed into not increasing rates or tamping down their rate increases, because in my opinion, they should not be reacting to these kinds of news events. Now, if it was a much bigger effect, more like we had in 2008, 2009, or much bigger issue, perhaps. But I think the Fed stopping right now could be really damaging to the overall markets for sure, but also to just progression. So that's another big headline. So let's go into the slot updates, and I'm going to share my screen with you here. So here I come. All right, you should be seeing my screen here that reads, "Can I reach my 401k funds while still working?" So Ian writes about this, and I included it this week because this is a common question we get. And not only do we get this question, but we sometimes get conflicting information presented by the 401k providers, the companies, the HR folks in the companies. So and every plan is different. So you often hear me say, whether it's over webinar or now that we're back in live classes occasionally, you'll hear me say that there are certain rules that the 401ks where they're allowed to distribute money. So if you reach, the IRS says, and Ian's going to talk about it a little bit, but the IRS says that you can access your 401k if you reach the age 59 and a half and do what's called a non-hardship in-service distribution. But so there's very little limitations on that. The IRS says you can do it. You're over the age 59 and a half. And what that means is that even though you're still working with the company, you can still, you can roll over your funds into an IRA. There's no tax on that as long as it's done properly. And that's a hard one to do improperly, frankly. But you roll it into a traditional IRA, you don't pay the tax, and then you have some more control. You can, if Roth conversions make sense for you, that's taking it from your traditional IRA to a Roth IRA to pay the tax now and potentially save tax later, then that can make sense. Maybe it's your investment options. Even our own 401k here at Attleboro Wealth Management, I wish they had some better investment options. So, sometimes it makes sense to roll that into a 401k. And then there's also fees. 401ks have this, there's kind of this myth sometimes that there are no fees or they're low fees, and that's not always the case. So it makes sense to consider all these things. So the IRS says you can do that. You can roll that 401k over to an IRA after age 59 and a half using this non-hardship in service distribution allowance. And again, that just means you can stay in your plan, but you can take that money out and roll it into an IRA. But the plans can be more restrictive, and they can be very, very restrictive. TIAA, for example, we often refer to them as a TIAA mafia. They often don't let people take more than 10% of their money, even if they're retired, out of their company plans that they cover. And I still don't know how they get away with that, but that's kind of that's not for me to determine. But the plans can be more restrictive, so you have to understand your plan. So Ian writes, we continue to get questions about the ability of employees to withdraw from 401k plans while still working. The tax code includes certain restrictions on these in-service withdrawals. Plans must follow these rules or they risk losing their tax qualified status. So an in-service withdrawal just means you're still in service with that company. You're still working there. So I'm moving here to, but plans are also free to impose even more restrictive rules than required by the tax code. So you'll need to check your plan summary or ask your plan administrator or HR rep for the particular withdrawal rules that apply to your plan. Listen, if you can determine the rules from your plan summary document, right? Plan summary document is usually what it's called. God bless you, because most people can't. So ask your HR rep, ask your plan provider, and hopefully they have the right information. Often we have to get on a conference call with folks to get the right questions answered. So to get the right answers to the questions. So here's a summary of the various withdrawal restrictions. Ian writes, pre-tax deferrals and Roth contributions. Your plan cannot allow in-service withdrawals of pre-tax deferrals and Roth contributions if they offer them, plus associated earnings before 59 and a half, except for hardship or disability. That's if you're still working there. Of course, if you retire and you have a previous 401k or some other retirement plan from your previous employer, of course you can roll that over to your IRA. You're not connected to that company anymore. We're talking about when you're still working at the company. How about after-tax contributions? If your plan offers non-Roth after-tax contributions, the plan can allow those contributions and their earnings to be withdrawn at any time, even before age 59 and a half. This allows employees in some plans to use the mega backdoor Roth strategy to convert after-tax contributions to Roth IRAs. That's a great strategy if it's available to you. If it's something you want to explore, reach out to us. And we can do it, but that's an allowance where you can access your current job 401k, the non-Roth after-tax contributions, and the earnings prior to age 59 and a half, even if you're still employed there. How about employer contributions? The IRS rules are very flexible in permitting in-service withdrawals of vested company contributions, such as matching or profit-sharing contributions, and their earnings. Plans can allow withdrawals at a specified age, even earlier than 59 and a half, after at least 5 years of plan participation or after the contribution has been in the plan for at least 2 years. Do you see how these rules are confusing? You see, there's just different layers of time and confusion around here. So that's, again, another reason why you've got to find a qualified expert to help you with these things. But most plans that allow in-service withdrawals of these funds don't permit them until age 59 and a half, as with pre-tax deferrals and Roth contributions. This simplifies plan administration and prevents employees from getting hit with a 10% early distribution penalty. So moving on to safe harbor contributions. Your employer can make safe harbor contributions, employer contributions, to allow the plan to automatically satisfy certain IRA limits on contributions by highly paid employees. 401k plans, retirement plans have to go through, certain retirement plans have to go through an annual testing to see that highly compensated people aren't being treated differently than folks that are not compensated as highly. So they want to make sure that everybody kind of has balanced contribution levels. But the company can make safe harbor, and this is company employer contributions. The company can make safe harbor elections that cover this testing requirement. So these safe harbor contributions and associated earnings aren't eligible for in-service withdrawal before 59 and a half. How about rollover contributions? Some 401k plans allow employees to roll over pre-tax retirement accounts, including IRAs, into the plan. Plans can allow in-service withdrawals of rollover contributions in their earnings at any time, regardless of age or service. But this is not mandatory, and once again, many plans set age 59 and a half as a cutoff point to make administration easier. Be careful about that, because you might roll over an IRA into a 401k for whatever reason. So it was already your IRA on your own, and you roll it over to a 401k. The plan can say you can't have it back if you're still working here until after you're 59 and a half. Your employer isn't required to offer withdrawals for any of these reasons, but if offered, you'd be able to access, I'm sorry, I missed the first part of Secure 2.0. So I'm right here, Secure 2.0. The new Secure 2.0 law includes several new in-service withdrawal opportunities. These include withdrawals for federally declared disaster expenses, retroactively effective to January 26, 2021, for terminal illness, effective in 2023, for victims of domestic abuse, and for emergency expenses, both effective in 2024. Why couldn't they make that one effective in 2023? And for long-term care premiums, effective December 29th, 2025. Your employer isn't required to offer withdrawals for any of these reasons, but if offered, you'd be able to access your accounts even before 59 and a half without paying the 10% penalty. Remember, you'd still have to pay any tax that's due on those withdrawals. We're talking about accessing prior to 59 and a half without penalty. Now, we're not talking about rolling these over. Rollover is tax-free, but if you take a distribution and you use it for one of these emergencies, then you have to pay tax, but you don't pay the 10% penalty that is imposed if you take out of your plan or your IRA prior to 59 and a half. Except possibly for terminal illness, where the law is unclear. We have a lot of things to clear up with the Secure 2.0. All right, so Ian just tells you what I just told you here. Taxation in-service withdrawals of pre-tax 401k plans, 401k funds are taxable, and if made before 59 and a half, may be subject to penalty. Roth accounts and after-tax contributions are handled separately. A Roth 401k withdrawal that has a qualified distributions comes out completely tax-free. Of course, it's a Roth. If not qualified, the earnings part of the Roth withdrawal is taxable. The earnings portion of each withdrawal of after-tax contributions is also taxable. All right. I think that's all we have for the Slott report today. Oh, no, we have questions. We have the mailbag. So Sarah Brenner answers our mailbag today. And the first question is, this sounds like a financial professional. Hi, I'm looking forward to the July workshop in Boston, but hoping you can help with this question now. So this is a person who's not necessarily part of the Elite Advisor Group or Master Elite Advisor Group, but several times throughout the year, Ed and his team hold training sessions for folks who are not part of his group. These aren't required like the training sessions they have that are required, but they have these workshops all over the country, and I'm sure the Boston is going to be a fun one in July. It's a great city to visit in the summertime. What happens, Matt writes, what happens if an account holder who is over age 59 and a half does a Roth conversion from his traditional IRA, but dies before the 5-year holding period? This is a great question. So any Roth has this 5-year rule. Over 59.5, it's relatively simple. You have to have any Roth account in place prior to 5 years for the earnings in that Roth account, whether it's interest or growth, to come out tax-free. So this is a good question. So what happens if this person dies prior to the 5-year holding period? What happens? So he's talking about for the beneficiaries, of course, because the person who dies, it doesn't matter, right? So if an IRA owner converts to a Roth IRA and then dies within 5 years, any converted funds will be immediately accessible to the beneficiary, tax and penalty free. However, if this was the IRA owner's first Roth IRA, then the beneficiary would need to wait out the IRA owner's 5-year holding period before any earnings in the Roth IRA would be available tax-free. The earnings would not be subject to the 10% penalty, distribution penalty, because that penalty never applies to inherited IRAs. And then he goes on to say, looking forward to seeing you in July. So it has to follow those same ordering rules and 5-year rule, just as the owner would have for an inherited IRA. Great question, Matt. And here's our next question. It's from Steve. Hi, my wife and I each have inherited IRAs as well as our own. I'll be 73 next year. She's a few years behind. The RMD rules on our inherited IRAs are complicated, but I've paid attention and I think I have a good handle on ours. But there are too many accounts, ! He writes. My IRA, her IRA, my Roth, her Roth, my inherited IRA, her inherited IRA, her inherited Roth, all have different rules and must be kept separate. But I'd like to use RMDs to eliminate the small accounts and simplify things. My question is, when I calculate the RMD on my IRA, do I include the value of my inherited IRAs in the calculation? Does taking an RMD from an inherited IRA count towards my RMD for a given year? One inherited IRA is fairly small. I'd like to take it all to help satisfy my RMD next year and eliminate that account. So let's see if anybody wants to chime in here, because you all are becoming experts in this. So he's asking, can he include when he calculates the RMD on the IRA, does he include the value of the inherited IRA in the calculation? Does taking RMD from an inherited IRA count towards my RMD for a given year? This is a big question. It's really common. So the writer here, Steve, is asking, can I let's just say he's got to take $10,000 out of his IRA, and he's got to take $5,000 out of his inherited IRA, and his inherited IRA is only worth $15,000. He's saying, I want to get rid of these multiple accounts we have all over the place. Can I take $15,000 out of my inherited IRA, and it'll cover the RMD from the inherited IRA, and it'll cover the RMD that's due in my own IRA, Steve's asking. So let me know what your thoughts are about that as we go. But I'm going to pause for a second because I just want to see if anybody answers. But here's the answer. Well, you can't combine inherited IRAs and traditional IRAs. And he said it in the beginning. Steve said, all have different rules and I'm right here. All have different rules and must be kept separate. And they all have different rules and must be kept separate. So Sarah writes, the rules on aggregated RMDs can be tricky. You can aggregate RMDs for your own IRAs. That's okay. You can do that and take the total from one account. However, you cannot aggregate RMDs from your own IRAs with any from inherited IRAs. Unfortunately, you will not be able to take the RMD from your own IRA from the small inherited account. He also can't combine or aggregate these RMDs with his spouse's IRA. People think that too. Well, can't I just take it from mine and leave hers alone? Or can't I just take it from hers and leave mine alone? These have very, very distinct rules and requirements, and you have to treat them separately. Again, you can aggregate your own IRAs. If you have 5 IRA accounts and they all together, you have $20,000 in each, and it's $100,000 altogether, you can take your distribution from one of those IRAs. If you layer in an inherited IRA, you can't aggregate that. Your retirement plans, you can't aggregate those into that. They have to be done separately. And certainly you can't include somebody else's accounts. Great questions. Okay. Let's go back and stop my sharing. All right, so now let's talk about the markets. So I shared with you that we're expecting, or the Fed is going to tell us if they're raising rates tomorrow. I'm expecting that they're going to. I hope they do, frankly. But markets last week, as far as returns, the Dow Jones Industrial Average was down about 0.11%. The S&P 500 was up 1.47%. The NASDAQ was up 4.44%. Now, I want you to think about that for a minute. So we got pummeled in the banking industry, right? So financials certainly took a hit. A lot of consumer concerns about the banking industry as a whole. The Silicon Valley Bank, the trouble they had really had to do with managing long-term interest rates. Signature Bank was a completely different thing. It had to do with cryptocurrencies and whatnot. But so as the Fed raises rates, as I said, we're going to start seeing these cracks become larger issues. Market just doesn't seem to care much about this, does it? So the S&P 500 was up 1.4%. The NASDAQ was up 4.44%. So some of the world indices around the globe down 3.11, down 0.26, down 3. I'm not saying that this is a good thing, by the way, but this is one of and I'm also not saying it's a bad thing, but this is one of the things that the Fed is fighting. Could you imagine being on the board of directors or the board of governors for the Fed, and you're trying to make these decisions about employment and inflation? That's really the Fed's dual mandate. Let's keep maximum employment and minimum, well, I just banged the microphone, minimum inflation. And that's the balance. And by the way, don't destroy the markets or the economy on the way. And, they're raising interest rates, and they see that we've got some banking issues. Inflation continues to be high, but the economy just continues to go. And our unemployment numbers are still very, very low, which is a good thing. But at some point, you just got to be an adjustment. So I don't know how they're going to handle it. But I hope it's certainly not pausing right now. So then, big move in bond yields. So in U.S. Treasuries last week. So the 6-month Treasury on Friday was yielding, right, what the interest is, 4.6%. A week before that, it was 5.05%. So that's a big drop. So big move in the Treasuries. And that's 6 months. 2 years went from 4.59 to 3.84. Big drop. Now, remember, just a year ago, that 6-month Treasury that I just told you ended the week last week, 4.6 was 0.77. So a big drop. Thank you to my friends at Invesco for supplying that information. The Wall Street Journal writes, the banking turmoil could create more challenges for U.S. consumers. Unrest in the banking sector could make it more difficult for some consumers to obtain loans to buy homes, cars, and other big-ticket items, threatening to further cut into spending as households grapple with elevated inflation and rising interest rates. Economists say much of the near-term impact could depend more on American psychology, whether they have confidence the economy will weather the banking storm that might or might not directly hit their pocketbooks. Federal Reserve officials, this week will decide whether to raise interest rates again to fight inflation or take a time out of the banking crisis. Let's hope that we see some spending curbing a bit, because we're starting to see the effect of the housing market and whatnot. And I guess the auto market is slowing, I hope, a little bit. But I don't know. It doesn't seem overall that people are yet getting their arms around the fact that, we've got a difficult economy and we have to deal with it. And it might be a good idea to keep some money on the sidelines instead of spending it all. BlackRock writes, financial cracks show what to do now. So more financial cracks from rapid rate hikes are emerging. We stay underweight stocks, downgrade credit, that's bonds, and prefer short-term government bonds for income. So they caught up to what I've been saying for the past 6 months, that the short-term government, it just makes sense as the interest was getting higher and higher in these short-term government issues. Why would you go any further? Certainly for money you're going to need in the shorter term from now to 3 years from now. So bank troubles on both sides of the Atlantic. They hit the sector share last week. Short-term bonds yields plunged on hopes for sharp central bank rate cuts. They write, we don't see central banks like the Federal Reserve and globally coming to the rescue with rate cuts, but using other tools to ensure financial stability. The Federal Reserve is set to hike rates this week. Again, talking about the Fed and rate hikes. Everybody's talking about the bank. Empower wrote, they had a really great article. Again, it said, imagine sitting in the chair, being the chairman of the Federal Reserve, and they discussed that dual mandate, the Fed managing inflation, keeping employment at high levels, full employment without blowing up the economy. And with it, of course, the stock market. So good stuff from Empower, like always. All right, so moving on to our financial planning topic. Let me pull up my whiteboard first here and make sure that's all good to go. And you're going to see me looking down as I draw on this whiteboard. But here we are. This is what we've been calling our financial 15, and that's 15 minutes, give or take, of a financial planning topic that can have significant impact on your retirement plan. So if you're just joining us on YouTube for this is the financial 15, as I just said. So hit the like, subscribe, and notification button, and you'll never miss a video. Okay, so let's talk about today the 5 most common, I keep saying most common. I guess it all depends on who you are, but the five common retirement mistakes that I see. And we're going to just go through them one by one. So let's go with number 1. Not planning for or considering a significant market loss. So this may kind of seem like, okay, Mark, well, wait a minute. Everybody thinks about that. It keeps me up at night, what's going to happen. But, a lot of folks don't think about it. Or, a year ago, not a year ago, I guess, because we were starting to have our difficulties a year ago. Yeah, sure, it's March. So we were seeing slides in the market. But let's go back to 2020. So 3 years ago. 3 years ago in 2020, when I was teaching my live classes, I was reminding people that the markets could lose money. And talking about the Great Recession and saying, you could see a 20, 30, 40% drop in your holdings. But people kind of just had, they plugged up their ears. I've been doing well. I'm doing it on my own, or my financial advisor is great. And we keep making money every year. And that's how it was for a decade and a half or more, with some blips along the way. But it's been more challenging for sure since the pandemic. But even the pandemic kind of gave us this false security around because in March 2020, the markets dropped dramatically, and they started to come back again really strongly in June. And we have this, you've heard it, this V-shaped recovery, and it just ran and ran and ran until the end of 2021. And then 2022 was difficult. And for a lot of you folks listening to this, whether live or on YouTube, many of you are probably coming into retirement or so you're nearing retirement or already in retirement, and you have this worry zone, I call it. And that's healthy, by the way. It should be managed, but it's healthy, because if you're not paying attention to this, not planning for or considering a significant market loss and over a longer period of time, because don't forget, I think that we could be in this for the next 1 to 5 years. And it could, modest returns, we're going to talk about that in a minute. It could be much longer, but you run into the sequence of returns risk. So what is sequence of returns risk? That is when you have negative returns early in your retirement that you can just never recover from. Because if you're not invested properly, if you don't have a proper segmentation, financial plan, etc., then you're drawing from investments that are potentially down. And last year, you got hit with the bond market being down and the stock market being down, sometimes considerably. So even your safe, air quotes, if you're just listening, bond money was down. Then you're drawing on this money because you have to spend that money, or you want to spend that money, and that can have a significant permanent impact on your investments, therefore your standard of living in retirement, and your chances of having a successful retirement. So successful retirement is different for everybody, of course. Most people, they want to have their needs taken care of. They want to make sure they've got money at the end of their life, and then whatever's left passes to their heirs as efficiently as possible. Now, some people say, I want to spend my last dollar or last day on earth. And that's a really, really nice and kind of cute statement. But, how are you going to ever plan for that? So you want to make sure you've got a buffer there, and then you decide where that buffer goes, because the thing is that you can plan to 85, but you might be here till 95. And frankly, if you plan to 95 and you're going to spend your last dollar on your last day here at age 95, and you live to be 96, that year from 95 to 96 is going to be pretty terrible. So you've got to plan for a significant market loss, because it's very likely to happen to you in 20, 25, 30, 35 years of retirement. Probably a few times during this time. So you have to plan for those things and be aware of them. And there's things that you can do to mitigate those. You've heard me talk about it. The 3 pillars of investing. If you haven't heard that rant yet from me, the 3 pillars of investing, go to our website, attleborowealth.com. Go to the services section, drop down at where investments are, and you'll see a video, 3 pillars of investment, or search it on the YouTube channel. Okay, so you got to pay attention to a significant market loss. How about even just as bad, I guess, as a significant market loss is not planning for or considering slow growth. So I want you to read this with me. I'm right here. We expect U.S. equities, that means stocks, to return 4.7% to 6.7% over the next 10 years. So that's from Vanguard's 2023 Economy and Market Report. 4.7% to 6.7%. Anybody remember what inflation is right now? That's 6%. So if you return 4.7% after inflation, or let's split it in the middle. Let's call it 5.7%. If you return 5.7%, you're losing 0.3% a year, right? You're actually down 0.3% a year because your money is worth less. So this also is a gross return. That means you have to back out fees, and we're going to talk about all that, and expenses. So that 5.7% can come all the way down to 2 to 3%. So now you're really losing money. So we hope that inflation of 6% isn't with us for 10 years. That would be really challenging and hard to overcome. But just this short growth or small amount of growth over 10 years can be devastating also to retirement if you're not considering it. Because some people still think, when I was early on, when I went out on my own and became an independent advisor, I was invited to speak on CNBC. And the discussion was, I can't remember the other anchor, but Larry Kudlow was the one anchor. And we were talking a little bit before the episode aired. And the discussion was, because it was right coming out of the Great Recession, and there was some discussion about allowing people to remove money from their 401ks to invest in the housing market, real estate market, which would have been a horrible plan, obviously. But Larry Kudlow said, well, what about Mark, talk about the 12% average return of the stock market over 30 years. And a lot of people still have that in their head. Well, the market's going to return, somewhere between 11 to 12%, once we come out of this over X number of years. Well, that may be, and let's hope it does. Hey, listen, let's hope it's 20% it averages. But we better be prepared for more modest returns like 4.7%. Because this period of time that people are talking about, this 30-year period of time, that's it's not arbitrary, but it's really insignificant to you, because this might be, what would that be? 1997 to 2023. What does that matter to you? This was your working years, potentially. What you've got to worry about is 2023. And let's say the average of the markets over that time, it's actually come down. I think it's probably about 8 let's just call it 8% right now, where it historically, you really were looking at 11 to 12%. But the average has come down over the last 30 years. But if your next 30 years is 2023 to what would that be? 2053. Ooh, that's a long time from now. The question is, what's that average going to be? If it's going to be 4.7% to 6.7%, that's going to be troublesome for a lot of people. So Vanguard's only predicting this for the next 10 years, and that's great. So that's good information. And it may not pan out that way, but you have to focus on what your period of time is, not some number that, a mutual fund or an investment manager says, this was the return over the last 30 years, because that's not your 30 years. I hope that all makes sense to you. The other thing you have to consider when you're talking about slow growth or even no growth is you've probably heard the example of the lost decade. So from the year 2000 to the year 2010, if you listen to Susie Orman and invested just in the Vanguard or Fidelity S&P 500 index, low cost fund, and it's important to do that, and we're going to talk about that. But if that's all you did, does anybody know what your rate of return was from 2000 to 2010? So I've got a really smart and sophisticated group of individuals here, and I'm willing, a lot of people are thinking right now that rate of return that you received was 0%. So from 2000 to 2010, almost to the point, the S&P 500 returned 0%. Now we're going to talk about investment costs for a second, and this doesn't account for 1% advisor fee, 2% fund fees, another 1% in trading fees. So that's 4%, folks. So that's a negative 4% return that you've actually experienced during that time. You've got to be aware of these things, and you've got to figure out what awareness is key. And then once you identify these potential issues, you have to figure out ways to address them. So that's mistake number 2, not planning for or considering slow growth. All right, now we've talked about fees, but paying excessive fees and costs. Listen, I'm a financial advisor, financial planning, my financial planner, certified financial planner. My clients come to me because they want help with their plans and their investments and tax efficient planning, and we charge a fee for that. So I'm not saying, of course, that folks shouldn't pay our services, but you've got to check in with these things and make sure there's a value for that. What are you getting for these fees when you're talking about advisory fees? I was asked to speak. You may have heard this before, but I think I'm remembering right that it was in Dallas, Texas. And I was asked to speak to a group of financial advisors, and there were probably 100 some advisors in the room. And right before me, a company came up, a company from the Pennsylvania area called SEI came up, and they said the fair cost of just managing investments. So to pay a financial advisor to just handle your investments, they said at the SEI was 0.25%. The average cost in the industry is still well over 1%. I think it's 1.05. So they talked for a while. They shared their study. And by the way, this study I can't find it on, I was looking for it this morning, but I can't find it on Google anymore. So maybe they got some pressure. I don't know. But they talked about the study that they did that showed the real value of just asset management, just helping people with their investments only, was 0.25%. And the industry standard, even today, is 1.05%. So after SEI came up, I said that, and everybody in the room was grumbling. I had a chance to come up and talk about financial planning. And I said to them, okay, well, SEI just told you that everybody in this room is overcharging. And by, in this example, 0.80%. I said, this is how you can bring value to your clients and maintain those relationships and cover that additional fee. And that, I always tell people that our typical fee is 1%. And it goes down from there depending on the amount of money that you have with us. But and I acknowledge that about 0.25% goes to the investment management portion of it. And we have a different way of investing or managing investments and choosing investments. And I'm happy to share that with anybody who wants to talk about it. And you've heard me talk about it before, the account segmentation. And, we specifically hired a research group to assist us in our research and implementation of these strategies. But we account for that about 0.25%. The entire remaining 0.75% of that one is financial planning. Financial planning, tax efficient planning, saving our clients millions of dollars potentially and often over their lifetime just by having things situated the right way and doing it and reviewing it every single year. Very, very important. But that's where the rubber really meets the road for us. So if you're paying advisory fees, what are you getting for those fees and are they fair? Look, there's still people that are charging 1.25%, 1.5% just for managing investments. I don't think that's fair. I don't think it's appropriate. There are also folks who, they'll like I just told you, we hired a firm, Cornerstone Portfolio and Research. Sorry, Cornerstone, if you're listening. Cornerstone Portfolio Research. They're strategic partners of ours. We pay them a fee to help us do all this work. We don't charge our clients that fee, but there are advisory firms that do that. They'll say, we're going to send your funds over to this investment company, XYZ investment company, and we're going to watch them and they're going to manage your assets. And then they'll add. So not only are they charging you, 1%, but then they're going to add 0.25% on top of that or whatever that investment company's fee is. We don't do that. And I don't think that's appropriate. The research that, I didn't mean to erase that. The research that we pay for. So I'll get off my high horse and my soapbox there. So advisory fees, what are you paying and what do you get for those fees? Mutual fund fees. I want to share with you something. So we all know that mutual funds can be more expensive. Sometimes it makes sense to pay those fees, and people always zero in on these expense ratios. Well, gosh, that mutual fund costs 1%, costs 0.95%, or you can buy an exchange traded fund for 0.1% or 0.03%. And that's a great argument. And we use a lot of exchange traded funds in our portfolios because they are cheap and efficient. But sometimes it makes sense to use a mutual fund because you have an active manager there who is looking for opportunities. And it only makes sense if if they can help you earn that extra money beyond what you're paying them. Pretty simple concept. However, we know that statistically something like 92% of the fund managers out there stink or are mediocre. So we only have about 6 or 8% of the population of professional money managers who can earn their keep. That's why I always challenge people who want to do this on their own. If the majority of the financial professionals out there have all the resources and all the technology and have people all around the world helping them put together these portfolios, if most of them can't perform well in a portfolio, I don't know how an individual thinks that they'll be able to, but that's not for me to decide. But people always talk about the expense ratios of these mutual funds, and they should, but there's more to that. So I put together this little chart here. So here's an example of mutual fund fees and things you have to look out for. So of course, this shows a 0.9% expense ratio on $500,000. And that's what people think about when they think about mutual funds. And that could cost you a whopping $4,500 a year. Of course, that's going to affect your returns. But what about other costs, these phantom fees within mutual funds that you have to watch out for? Well, 1.44% is the average. The 0.9% is the average. 1.44% is average transaction costs in mutual funds. That's another $7,200. Nobody talks about that one. Everybody focuses on the mutual funds. You have to be aware about these things. There could be another 0.83% in what we call cash drag, and that's another $4,150 a month, or excuse me, annually. If I said a month for these, I meant annually. On $500,000. So what cash drag is when mutual funds have to hold a significant amount of cash to pay shareholders when they want to redeem their shares. So mutual funds have to have funds available to, if I go in and I want to liquidate $500,000 of a mutual fund, unless there's restrictions in place, in that mutual fund, at the end of any given day, I can liquidate that $500,000, and that fund company has to send it to me. Some funds have distribution liquidation or restrictions. They'll only liquidate periodically, but that's cash drag, and that can be expensive. That can be up to that's an average of 0.83%. I didn't make these up. I pulled this from a resource. So these are other costs in mutual funds that you have to be aware of when you're at any time, but certainly when you're in your retirement. Annuity fees and costs. We hear a lot about annuities and their costs. And again, annuities can be a powerful tool inside of your retirement plan if they're in the right buckets, if they're taxed the right way, and if their expenses are reasonable. But you have to understand the details about that, because those annuity fees can go from 0 to 6% or more. So you got to be aware of that. The next big mistake is not knowing your numbers. We've talked a bit about this. We went over this in a webinar all by itself, the Financial 15 of a webinar. But if you're not certain about your cash flow, what you have coming in, what you have going out, people come in and kind of give us a thumbnail of, I need $10,000 a month in expenses during my retirement. And then when we shake the trees and do our financial planning process, where we really spend time in digging in, and anybody who's done it can vouch for that we spend a lot of time identifying not only fixed costs, what we expect you to spend on an ongoing basis, but the weddings, the roofs, the cars, all the things that come in with that. And that's all part of, regular expenses and understanding your cash flow. And that means income, because as I said, people come to us and they'll say, we're going to spend $10,000 a month. And suddenly it's $13,000 a month when we do the analysis, or it's $15,000 a month. And even if it's just for a few years, that extra $5,000 a month can really have a negative effect on your retirement plans. That's a big mistake that I see people make. So not knowing your expenses, being uncertain about your cash flow, uncertain about your expenses, and unknown expenses. People aren't considering your Aunt Irma. Everybody knows your Uncle Sam, but people aren't considering your Aunt Irma until it often hits them. IRMA is the income-related monthly adjustment amount that drives up the cost of your Medicare premiums based on your modified adjusted gross income, and it looks back 2 years. And yes, sometimes when we're doing tax conversion strategies or Roth conversion strategies and tax-efficient planning, sometimes it makes sense to pay that IRMA for at a higher rate for a shorter period of time rather than paying it for the rest of your life. But that's a calculation you have to do. And we do a calculation for all of our clients to make sure that it makes sense for them. But so many people aren't even considering that. It's not even on their radar. Tax on your Social Security. Younger folks who, if coming into age 60, sometimes people don't realize that your Social Security can be taxed up to 85% of your benefit. Your Social Security benefit can be subject to tax. That's not 85% tax. It's 85% of your benefit, up to 85%. It could be 0, could be up to 50, could be up to 85%. But that means you may have to send a good portion or some of your money back to the federal government when you start collecting your Social Security. Tax is one of your largest expenses. Sometimes people aren't even considering that, and most large financial advisory firms won't even touch it. Now, I just grabbed this, and I'm not picking on Morgan Stanley. This is just Morgan Stanley's. Let me make this a little smaller because it's so darn long. Ooh, okay, I'm going to have to scroll it. This reads Morgan Stanley Smith Barney LLC, Morgan Stanley, its affiliates of Morgan Stanley Financial Advisors or private wealth advisors do not provide tax or legal advice. Do not provide tax advice. Clients should consult their tax advisor for matters involving taxation and tax planning, and their attorney for legal matters. So they're saying, we realize this is one of the largest expenses during your retirement, but we're not going to touch it. Why don't they touch it? Because it's really complicated, and it's got you hear all the different moving parts, and well, if this, then that kind of situation. Folks, this is a pet peeve of mine. The fact that they disclaim it on and again, it's not just Morgan Stanley, it's Wells Fargo, it's Merrill Lynch, it's all the big firms. We do not give tax advice. Folks, we give tax advice. We work with your CPAs. We do tax planning. We set things up. That's how it should be. My goodness. So your tax planning and again, one of your large expenses, not checking in, keeping things on autopilot. Look at your statements. Another pet peeve of mine is when people say, oh, the markets are really challenging right now. Don't bother looking at your statements. Don't even look at them. That is the wrong way to go. You have to look at those statements and you have to be aware of what's going on. Do you have to be an expert in all the nuances of what's on that statement and the details? Well, you should have a really good understanding of it, in my opinion, but you don't have to be expert. But my goodness, if your accounts are down, don't you want to know why your accounts are down? Shouldn't you be having discussions with whomever is helping you with that, or find somebody who can help you if you don't know the answers yourself? And it's not just, well, hold on, it'll come back. For crying out loud. You've got to have, sometimes it's just a gut check, but this is high stakes stuff, because if we have negative markets, even if we have soft markets for a long period of time, it can greatly reflect your standard of living in retirement, or, just your quality of retirement, or even if it's just what you are leaving to the next generation, if that's your goal. And there's no reason not to look at your statements. There's no reason not to have discussions. And there's no reason not to review it on a regular basis. So remember, you should review your plan at least once a year. And that's your entire plan. And you should be having discussions on a regular basis. If it's twice a year, even if it's just once a year, or open up your statement and, hey, I got questions. Why is this? Why is this down 10%? Why is this up 10%? What's going on with this? It's really important to have that. So that's number 5, but there's more. Of course, investments in the wrong buckets. You've got your taxable bucket. You got your tax deferred bucket. You've got your tax advantaged or tax-free bucket over here. Having the right amount of money in each one of these buckets can have a huge impact on your retirement distribution planning. And of course, your order of distribution and more. So they're the big ones, folks. The 5 common, did I say it again? Yes, 5 common retirement mistakes. But there's more. So plug yourself in, pay attention to these things I talked about today. Keep yourself educated, stay on top. This is serious stuff. If you just think about it, we call this the Financial 15, because if you just listen to this or watch this 15 minutes a week, you'll be better off than most of the folks around you. Frankly, you'll be better off than most financial advisors out there, because we talk about topics that most people aren't talking about. These IRA distribution planning, but you're going to be better off than certainly 90% of your peers out there, for sure. So just attend these webinars, attend classes when they're available to you. You only get to retire once, and it should be as enjoyable as possible. So that's it for today. We'll see you next week. I don't see any questions. If you have any questions, if you want to schedule time with us, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. Stay tuned for our website. Stay tuned for the recording I'm going to send you about this webinar. If you're on our mailing list, if you're not on our mailing list and you'd like to be, you can send me an email at questions@attleborowealth.com, and we'll be sure to get you on our mailing list. I guess I should put on a form to fill out on the YouTube channel for a mailing list. That would probably make sense. But I hope you enjoyed this today. I hope you learned something, and we'll see you next week. Take care.